Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play, and today we're going to be talking about using credit vertical spreads to generate income and how can you maximize your income using this very versatile strategy that you can use across many different outlooks, different market conditions, but it is a strategy for a very specific type of market outlook. So today what we're going to do is we're going to talk a little bit about the strategies themselves, talk about the technical analysis that's typically that goes along with this type of strategy, and really understand the benefit and flexibility that this strategy provides you with depending on specific market outlooks. Now, credit spreads is a more advanced strategy typically. It is something that we're going to do in order to learn more about credit spreads is we're going to break down the strategy itself into its two primary components, talk about how each component works so that you can better understand how the strategy works. And this strategy does require a bit of understanding of options. So in order to really understand this, I will try to break this down as simple as possible. So for those of you that are familiar with calls and puts and how to speculate using the strategy, I want to try to present it in a way so that anyone with a basic understanding of calls and puts can understand and utilize this specific strategy. It is a strategy that's very forgiving, and that is, I think, why a lot of people like to trade it. They do typically have higher probability of profits, and the fact that it's very forgiving seems very attractive for many investors. But I do want to make sure that you understand the flip side to that high probability, which is poor risk to reward. And that is the nature of this type of strategy, is that you do have very poor risk to reward ratios. So it's important to understand what those mean before you go ahead and start executing these types of trades. Now, this strategy is suitable for those of you that are already selling naked calls or naked puts, or even covered calls, because it is a strategy that's very closely related to those options selling strategies. And what we will talk a little bit about are the quantitative resources that we offer here at Options Play that incorporate the back testing, the statistical research that we do, and our in-depth understanding of these types of strategies into a service that you can actually subscribe to. So we have a very special webinar offer for you here today. As always, this webinar is recorded along with the slides are presented to you guys about 30 minutes after we finish here today. And what we're going to do is we're going to break down the strategy. We're going to talk through best practices. And as always, we want to go through as many live examples as possible, because I always think that that's the best way to teach these types of strategies. So let's go ahead and get started here. Before I do that, just a bit of housekeeping. What I'm going to talk about here today is the strategy itself. But Options Play, we also offer a service that provides signals on credit spreads. So for those of you that love this strategy, for those of you that like trading credit spreads, we do have a separate service that we offer through the StockTwits rooms. That's a $39 a month add-on to your Options Play account. And this provides you with daily trading signals that are delivered to your email and phone notification through the StockTwits app. And we do have an exclusive webinar discount code for those of you that are interested in trying this out. We have a free 7-day trial. And then after that, you have a 20% discount off of the tool itself. And I'll send everyone the link into the chat window if you want to take a look at this and utilize that for your trading. So for those of you that are interested in learning more or want to follow a service, we do have a credit spread trading service that you can follow along for this specific strategy that we're going to discuss here today. So with that, I'll start off. I'll talk about what are credit spreads. This is for those of you that are relatively new to this strategy. I'll break down to its two primary components so that you can understand basic calls and puts and really get a sense for how to utilize this strategy. Then we'll talk a little bit about when should you sell credit spreads, because that's actually, in my opinion, one of the most important things to get from this specific webinar, because credit spreads are used for very specific outlooks. They are not used for any directional views that you have. They are used for very specific types of directional views. So I want to frame that so that you understand when to deploy these strategies. Because again, these strategies have poor risk to reward ratios, so they're only suitable for certain market environments. So it's important to understand what those are. Once we understand the strategy itself, when to use it, then we'll talk about what are the optimal spreads, meaning what are the optimal expiration dates, what are the optimal strike prices, and then more importantly, how do you actually trade these, or how do you manage these trades once you're in them. I'll give a quick overview of the credit spread trading signals for those of you that want to learn more, and then I will jump over to options play to show you some real examples, showing you the comparison between the credit spread that we're going to go over here this week versus the debit spread that we talked about last week. I think it's important to put the two side by side so that you can see how they perform in different markets and see that when you have different expectations of the market, why these two strategies are used in very different outlooks. So I'll go through some real examples to show you that. So let's go ahead and get started. First of all, what are credit spreads? Before I break down how credit spreads are constructed, it's just important to understand that credit spreads are a strategy just like debit spreads that provide a limited risk and reward strategy with high probability of profit. Now, the high probability of profit piece is what I think attracts many users to selling credit spreads. This is a strategy where you are short theta and short volatility, which means that time decay is working in your favor. And as this specific trade, you want volatility to either stay constant or move lower. So you want quiet, you want calm, and that's why typically this is considered a strategy for neutral markets, because you want calm for this specific strategy. And you have two strategies. Now, when I refer to bullish and bearish for this strategy, what we're really talking about is more of a neutral view on the underlying stock or ETF with either a slightly bullish tilt or neutral with a slightly bearish tilt. And it's important to understand that when we say bullish and bearish, what we're really emphasizing here is actually the neutral part. So again, this is a strategy for when you have a neutral view and you just might simply have a slight bullish or bearish tilt to it. So for the bullish neutral trade, there is what we call a bull put spread. For the neutral bearish trade, there's a bear call spread. Those are the two spreads that we're going to break down here today. You don't necessarily have to memorize this, but it's just important to understand that there's two strategies that you can trade. Now, from my perspective, the easiest way to remember is they are opposite to buying a call or a put, because buying a call is bullish, buying a put is bearish. When you're selling credit spreads, the exact opposite. The put spread is the bullish strategy. The call spread is the bearish strategy. So with that, let's go ahead and start looking at this specific trade. Now, to teach the concepts, I always like to use stock XYZ trading at $100. Now, in this particular case, let's say I have a slightly bullish to neutral view on stock XYZ. And I think a good example of this is if the stock is trading around $100 or so, maybe it's just near a $100 support level. And I basically feel that the stock has reached this support level and it's just going to stay somewhere around this level, meaning I'm not too bullish on it, I'm not too bearish on it, but I certainly don't believe that this stock is going to continue moving substantially lower below that $100 support level. So as long as I think the stock is going to stay within a sort of range like I have here, and I don't think it's going to come down below that $100 level, that would be generally a reason for me to consider selling a put credit spread. So how do you actually construct a put credit spread? Fairly simple. I'm going to break this down into two separate trades. First of all, because if I think that the stock is around this $100 level, and I think that it's just going to sit around this level and maybe bounce a little higher, maybe test that support level again, and just generally speaking, maybe stay around this particular level, what I want to do is I want to sell a $100 put. Now, that in itself is the sort of bullish neutral part of this specific trade, because if you sell a $100 put, what you're effectively saying is I don't think the stock's going to go below 100. And that's the easiest way to express I don't think a stock is going to go above 100 is by selling a 100 strike put. So let's say I do that and I collect $4 in premium on this $100 put. So that's this trade right here. I'm basically selling a put. That's what the risk profile of a put looks like. And I collect $4 to do so. Now, on a $100 stock, if I'm only going to collect $4 and I have unlimited risk to the downside, because when you sell a naked put, you have unlimited risk. As the stock keeps going lower and lower and lower, you're going to risk more and more money. So even though I think the stock's going to stay above 100, there's always the chance that I'm wrong on this trade. And what happens if the stock falls right through it and goes all the way down to 90 or 80 or 75? That's really where I can have some severe losses if that happens. So that's why when you're selling a put credit spread, you don't want to just outright sell a put because you have unlimited losses to the downside. What you can do is you can buy a $90 put against that and limit your risk. So when I buy a $90 put, what I'm effectively doing is I'm capping the risk that I can lose on this put spread. So I still expect the stock to stay above 100. That's my expectation. But if the stock does go below, significantly lower, I don't risk more and more money. I'm only risking a certain amount of money. And that's really why we want to sell a credit spread, is to be able to take advantage of a slightly bullish view, but do so in a way that doesn't risk a large amount of capital. So by buying this $90 put, I collect $1. So instead of collecting $4 in premium, now my credit that I receive is only down to $3. However, instead of making $4 while risking a $96 to the downside, I can basically collect $3 in income, but then risk only $7. So again, the main point of buying this $90 put is so that I don't have unlimited risk to the downside. Now, the attractive part about this trade is the fact that I expect stock XYZ to stay above 100. That's why I enter this credit spread. Now, this strategy itself will make money if the stock goes above 100, but it will actually make money even if the stock drops a little bit below 100. So even if the stock goes to 99, even if the stock goes down to, let's say, 99 or 98 or 97, I can actually still make some money on this trade. So this trade is actually what we consider a very forgiving trade, because this strategy is actually profitable as long as the stock closes above $97 at expiration. So even though I think the stock's going to go above 100, but if the stock goes even a little bit lower to 98, 97, I'm actually not losing money. So it's a very forgiving strategy. And again, this is part of the high probability pieces, because even if I'm wrong on the direction, I can still make money. So you have a very high probability of profit. However, what you get with that high probability of profit is the fact that for every $3 in income that you receive, you're actually risking $7. So that risk to reward isn't particularly attractive. If you can make $3, but you can lose $7, it's not a great risk to reward ratio. But the trade-off of that poor risk to reward ratio is the fact that you have a high probability of profit. Now, I'll go through more examples of this to make this a little bit more clear, but that is in essence what a put credit spread or a bullish put credit spread looks like. On the flip side, if I have stock XYZ that's trading at $100, maybe it's approaching a $100 resistance level. So the stock maybe is rallying and it's hitting a prior resistance. And I believe that this stock is not going to go above that resistance level. I just think it's going to maybe trade sideways. This is really where a call credit spread makes sense. So for those of you that are familiar with selling covered calls, you might be familiar with what selling a 100 strike call looks like. So selling a 100 strike call, let's say that collects you $4 in income, that basically will profit as long as the stock doesn't go exceeding above 100. So as long as the stock stays below 100, you'll be able to make money. However, when you sell a naked call, that's when you truly have unlimited risk, because as the stock goes higher and higher, you're going to keep losing more and more money. So you don't want that to happen. So one of the ways you can prevent having unlimited losses is to buy a 110 call against that. So a higher call, let's say you for this, you pay $1 for it. So now what you do is you reduce your income from $4 down to $3, but instead of having unlimited risk to the upside, you're collecting $3 in income if the stock stays below 100, and you cap your risk so that no matter what happens, even if the stock blows through some really major resistance levels and rallies up to 120 or 130, you actually don't have unlimited amounts of risk. You actually risk only $7 no matter how high the stock goes, even if it goes all the way to 125. As you can see, what you get is effectively cap losses as the stock keeps going higher and higher. And that's the benefit of selling a credit spread as opposed to outright selling the naked call. In addition, many of you may not even have the ability to sell a naked call in your account. So that's why credit spreads is something that you can do if you just have, let's say, a level 3 options agreement with your broker. So just like the put credit spread, the call credit spread is also a very forgiving strategy in the sense that you could actually be wrong on your expectation that the stock is going to stay below 100, because if the stock rallies up to 101, 102, you will actually still make money on this strategy. Not as much money, but you'll still make money on this particular trade. And again, the downside is the fact that if you are wrong on the trade, you will risk more than the premium that you receive on the income on the credit spread. So again, high probability, very forgiving strategy, but the downside is the fact that you are risking more than the income that you are receiving on this specific trade. So with that, now that we understand the strategy itself, breaking down the different components of the strategy, let's talk a little bit about the strategy itself. Number one, like I said before, this is suitable for when you expect a neutral or a small directional move. And when we go through some real examples, I think this will become more apparent as to why. Because when you do get a larger move, there are better strategies for a larger move, such as the debit spreads that we covered last week. Credit spreads really only are useful when you expect a neutral or a small move. When you expect that big move, you're better off buying a call or a debit spread that's going to give you a better risk to reward ratio for a bigger move. Now, from a trading strategy perspective, this is useful when you are near extreme overbought or oversold conditions. So in the examples that I gave before, when the stock is either approaching a support level or approaching a resistance level, basically this is like one of these. If you ever looked at technical indicators that oscillate between a support and resistance level, these opportunities are the best times to sell a put credit spread when they're near a bottom or overbought or oversold. And when they're near a top, these are best times to sell a call credit spread or a overbought. So this is really when you want to deploy your credit spreads. So for those of you that are technical traders, whether you use momentum indicators like stochastics or MACD or RSI, any of these indicators that can identify overbought or oversold conditions when the markets are moving in a sideways market like this, those are ideal indicators to use to generate buy or sell signals on a credit spread. The other thing is a double top, double bottom formations. Anywhere where you have a clear sense for support or resistance levels are generally good times to sell a put or call credit spread. So if you have a stock that's approaching support and you're pretty confident it's going to bounce back up to resistance or vice versa, this is again ideal conditions to enter a put or call credit spread are near these support levels down here to sell put credit spreads, and near resistance levels selling call credit spreads. So all of these are different ways that you can use technical indicators to determine your timing on entry for these types of trades. And again, I will clarify once again that this is a strategy that you do not want to use when you're expecting a large or fast move. So if you're going into let's say a catalyst event. Now, this could be earnings, this could be a product launch, this could be anything that you think can cause a big movement in the stock. Generally speaking, not the best strategy. You can use them during earnings. Earnings is not a reason that you can't trade these strategies because you do have limited risk. And especially if you expect a pretty large collapse in volatility, the credit spreads do take advantage of that. But I will say that when you're trading these types of strategies, our research clearly shows that put verticals, meaning the bullish trades, have a clear edge over call verticals, meaning the bearish trades. And the reason for this is because when you're selling put credit spreads, you're basically saying that the stock is oversold. You're basically saying that the stock is oversold and that it's going to go bounce higher. Now, when this happens, when the stock becomes oversold and starts to bounce higher, during that time, what happens is you're effectively entering the trade when implied volatility is elevated, because when stocks fall, that's when implied volatility gets higher. And when stocks rally, the implied volatility contracts. So what you have is not only the directional trade working in your favor, you also have volatility working in your favor. Because remember, whenever you're selling these types of options, you have you're short volatility. So you want volatility to actually contract. And the only time this happens is when the stock drops, volatility is high, and when it rallies back higher, volatility contracts. So you have delta working in your favor, you have theta working in your favor, and you have volatility working in your favor, or vega. Conversely, if you were selling call credit spreads, it's just the exact opposite, because basically you're approaching a stock as it's near a top, which means that this is usually when implied volatility is lower, and you are expecting the stock to reverse lower. And when that happens, implied volatility expands. So even though in this particular case, both delta and theta is working in your favor, you have volatility working against you, because call credit spreads, you're entering them when volatility is fairly muted, and they expand on these types of declines. So you do have one component of the trade working against you when you're selling credit spreads, so in volatility that provides put vertical spreads have a slight edge over call credit spreads. So keep that in mind when you're thinking about selling these types of strategies. So just a quick reminder for those of you that did attend our webinar last week. Like I said, when you're trading debit spreads, debit spread opportunities do not happen very often, because you want to trade debit spreads when you expect a large move in the underlying stock, such as the breakout that I identified here on a triangle, on a stock that spent quite a few months building a triangle and finally broke out of it, and we saw a big move to the upside. These trades do not happen very often. Many times they might happen on the same stock just a couple of times a year. Versus credit spreads are useful when the stocks are trading more in a sideways market, or when they're near overbought or oversold markets, and they are oscillating between some kind of support or resistance level. And as you can see here, what we have here are many, many opportunities to sell put credit spreads here. Every time it hits that support level, it's an opportunity to sell a put credit spread. And every time it reaches that top, it's an opportunity to sell call credit spreads. So these are all opportunities to sell. So if you're a credit spread trader, you might find yourself actually trading credit spreads on the same symbol many times over within a short period of time. Versus debit spreads, you might only have the opportunity to trade once in a once a year, twice a year on the same symbol. So keep that in mind. That's what makes debit spreads and credit spreads so different and makes them almost impossible to compare. And it's not really worthwhile comparing, because they're used for completely different market environments. So now that we've kind of dissected the strategy itself, really understood when you should trade them and what strategies are best for different market conditions, let's talk a little bit about what are the optimal credit spreads. Because just because we're talking about credit spreads, you still have a lot of choice with expiration dates and strike prices. So when you're selling credit spreads, it's from our perspective, you can sell lots of different strike prices and expiration dates. Now, when I talk to users, I see a lot of users that sell credit spreads that use credit spreads that are really far out of the money, that have very high probability of profit. And I believe that traders gravitate towards that because they gravitate towards numbers that look like this: 90% winners, 95% winners. Doesn't that sound great? The flip side to these high probability trades is that you are risking a substantial amount of money for very little reward. Many times I'm seeing some index options traders selling credit spreads risking upwards of $4,000 or $5,000 for every $100 they're receiving in credit. And they're doing it because they're selling credit spreads that have 98, 99% probability of profit. And basically they win a lot. And there's no ways about that. They win a lot. However, they win really small a lot. And once in a blue moon, when the markets really have a massive move, and I'm talking 2008, I'm talking a flash crash we had between 2008 and the December 2018 crash, mini crash that we had there. These extreme moves are happening more often. And what's happening is that these credit spreads are not really fully compensating for that type of risk. And what we're seeing is that people that are collecting a few $100s a month all of a sudden have a $10,000 loss in 1 month, and they wipe out the last 40, 50 months of gains in a single trade. So that is the downside that you have when you're selling really far out of the money credit spreads, even though they have very high probability of profits. On the flip side, if you sell credit spreads that are very close to the current price, near the money credit spreads, you're going to see risk reward ratios that look something like this. For every $100 you receive in credits, you risk roughly about $200. Not a spectacular risk reward ratio, but also nothing like where I'm risking a couple of $1,000s for every $100 in income. And for those, you'll see typically in the range of 60 to 70% winners, and a 1 to 2 risk to reward ratio. So what we wanted to do was actually research all of these different possibilities of different combinations of credit spreads: selling at the money, selling out of the money, buying really far out of the money, buying relatively close to the money. And when we tried every single possible combination on S&P 500 stocks over the last 10 years, just to get a sense for where do you actually get the best return or the maximum income for this type of strategy in the long run, accounting for those big losses, and where do you come out ahead in the long run. So our research clearly shows that when you're using these types of strategies, that you're best selling very specific strategies. And these strategies became the best performing strategies across the board. All stocks, whether you're trading stocks, ETFs, indices, selling relatively short dated options 4 to 6 weeks out. Again, this is because shorter dated options will maximize time decay or theta. So we found that the sweet spot is in that 4 to 6 week range when you're selling these types of credit spreads. And we always want to sell an at the money call or put. So a 50 delta call or put, which in the stock XYZ example, if you felt that $100 was the support level, you want to sell that 100 strike put. And then to cap your risk so that you don't risk more money than, so that you don't have unlimited losses when you have a short put or a short naked call, what you want to buy back is roughly about a 25 delta call or put. And when you do this, the credit that you receive is roughly going to be 1/3 of the distance between the two strikes. So the distance between the two strikes are, in my example here before, let me just show you here. The distance between the two strikes is the distance between the $190 puts. So when I'm talking about selling a 100 strike put and buying back a $90 put, that's a $10 wide spread. So the width of that is $10. What you want to collect is roughly 1/3 of that, so about $3.33. That is, in our opinion, the best strategy to take when you're utilizing these put credit spreads. So when you're selling a credit spread that's $1 wide, you want to collect roughly about 33 cents. When you're selling something that's $5 wide, you want to collect roughly $1.67, so on and so on. But basically what you want to try to collect is 1/3 of the width. And when you do that, you are risking roughly $200 for every $100 in income that you receive. And for that, you're going to see winners in the 60 to 70% range. Now, again, we do this because what we want to do is make sure that in the long run, you're not risking more money than the income that you receive. And our research clearly shows that when you go to higher probability trades, yes, you will win more often, but in the few chances that you will lose substantially more than what you've gained all the other times that you win, simply because the risk to reward ratio starts to get worse and worse and worse to the point where it's not offsetting the risk of when you do get those big moves against you. So keep that in mind. Even though the high probability trades many times look attractive and sound attractive, in the long run, they don't work for you in the long run. So with that, I just want to talk a little bit about managing these trades. We've covered a lot here today. I want to make sure that I get to some examples for you and also show you how to access the tools to get access to the room for the credit service. So number one, you want to time your entry of credit spreads with expected tops and bottoms, especially if you have tops and bottoms where you don't have a strong sense that it's going to reverse substantially lower or higher based on a support resistance level. Those are ideal times to enter credit spreads. And for those of you that have watched my video on technical indicators, you'll know that I'm a big proponent of using technical momentum indicators like RSI, MACD, and stochastics, but I only advocate using them with credit spreads because those indicators do not, while giving you buy or sell signals, they don't give you a sense for magnitude, meaning you can get a buy signal on stochastics, but that buy signal itself, when you get that buy signal on stochastics, When stochastic gives you that buy signal, it does not give you a sense for whether the stock is going to reverse significantly higher or significantly lower. So when you have a stochastic signal that's giving you that buy signal, that signal itself is not going to tell you whether the stock's going to move 1% higher or 10% higher. There's no indication of that, which is why when you get those types of signals, you want to sell put credit spreads. So the entry part, I think, is fairly easy to understand for most people. Now, the goal of a credit spread is to let it expire worthless and for you to keep the entire credit. So this is a little different than buying calls and puts, where you generally want to hold, where you do not want to hold them to expiration. When you're selling options, you do want to hold them to expiration, just like selling a covered call, just like selling a cash secured put. This is really just a graduation of selling calls and puts into a slightly more complex strategies where you don't want to own the stock, or if you don't want to, or if you don't already own the stock. Now, when it comes to taking profits, there are rules where it makes sense to take profits early. So when a trade like this works out in your favor and you still have more than half the amount of time left to expiration, but you've made more than half of the gains. So if you've made more than 50% gains with more than half the time left to expiration, then we do advocate that you take profits early, because this strategy does, the risk of this trade actually starts to get higher as you approach expiration, especially if the stock's not moving a lot. The gamma exposure you have in this strategy gets higher and higher as you get closer to expiration, because if the stock goes even a penny below your strike price, you start to have significantly higher losses as you get closer to expiration. And to remove some of that risk, you can take profits early. So if, let's say you've made 60% of the gains in just 1 week, take that profit early. Take your capital and move on to the next one, because with these trades, you are risking substantially more capital than what you can potentially make on the trade. If you have the opportunity to take profits early where there's more than half the time left to expiration, go ahead and do that. On the flip side, if you need to cut losses, meaning if the trade is starting to go against you, so in this example, if the stock is trading at $100 and you think it's going to stay within that $100 support level, but the stock starts to move substantially lower, let's say it moves down to $97 or $96, now you want to consider cutting losses. Now, this is where it generally depends on how much credit you actually receive with respect to the width of the vertical. Now, if you follow the rules that we just explained to you here before, the credit that you receive will be greater than 1/5 of the vertical width, because you want to collect roughly 1/3 of the vertical width in credits. So if that's the case, you want to cut your losses at about 75 to 100% of the premium that you received. So if you received $1 and you're down $1.75, $2, it's time to get out of that trade. Conversely, if you are collecting those high probability of profit trades where you are substantially higher, where the credit received is less than 1/5 of the vertical width, that's when you want to cut losses at about a 100 to 200% loss of the premium that you received. So credit spreads from a management perspective is a little bit more complex, but if you follow our rules, they are fairly simple. You want to take profits when you have that 50% gain and you have more than half time left to expiration, and you want to cut your losses at 75 to 100. But if you deviate from our rules, you do want to make sure that you still have some kind of stop loss method, such as around 100 to 200% loss of the premium that you've received. So keep that in mind. If you are using your own rules for this type of strategy, managing these trades sometimes can get a little tricky. So with that, what I want to do is I want to talk, provide everyone with a webinar exclusive offer. So many of you are either currently trade this strategy or interested in trading this strategy. So one of the things that we are offering is a exclusive discount to this tool that we are offering through the StockTwits, and we are offering a discount code. So actually, I think that's the wrong code. Let me just make sure that I've got the right code here. Apologies. So the correct discount code is 20 off ops. So for those of you that want to sign up for options play, you can click on the link and on that sheet, and you'll be able to see you'll be able to click on the link and see the the offer with a way to sign up with the discount code. And with that, what you get is daily credit spread signals with real-time entry and exit signals on these types of trades. Email and phone notifications when we do send out those trade alerts. We average about 3 to 4 signals a week. And again, this discount code does expire, but that date is actually incorrect. I apologize for that. I will change that when I send out the slides with the correct date, but that discount code is good for 1 more month from today. So just to give you a sneak peek on this specific trading signal, what we are scanning for are quantitative algorithmic signals that identify extremely oversold conditions. We have a proprietary indicator here at the bottom that identifies when things are severely oversold. And what we're effectively looking for when the stock is severely oversold is a bounce in the stock so that it bounces, either moves sideways and bounces higher. And what we're really looking for is a very high accuracy rate because credit spreads do not take advantage of high returns, they take advantage of high accuracy. So what we're shooting for are trades that have about a 60 to 65% chance of moving either sideways or bouncing higher. And they typically average only about a 2 to 3% return over 4 weeks. So again, not a very high return, but relatively high accuracy, because that's what we're looking for when we're selling credit spreads. Because it doesn't matter whether the stock moves 1% higher or 10% higher, the income that you receive on a credit spread remains the same. So as long as the stock stays where it is with a high amount of degree of accuracy, that's what we're looking for. And what we've done with our credit spread service is not only do we identify these opportunities, we also send you the optimized credit spread. So everything that we taught you here today, we're going to send you real-time alerts with those specific expiration dates and strike prices. These are sent out intraday, unlike the daily plays that are sent out at the end of every single day that you get at 6 a.m. in your inbox every morning. These are sent throughout the day. And these have P&L analytics that you can use with Options Play. So we'll send you a link to the Options Play tool so that you can look at the trades yourself. You can even modify the expiration dates or strike prices if you want. You can use the P&L simulator to simulate different outlooks and see how these strategies perform. And we do produce weekly performance reports on these types of trades. And just to give you a quick sneak peek, to give you a sense for what type of signals you get. So here are some trade entry and exit samples. The entries will tell you exactly the symbol, the amount of credit that we're receiving. It tells you the buy and sell legs. So you get the expiration date, the strike price, the premium that we receive on the sell leg, as well as on the buy leg, and the net credit so that you can see your max reward, max risk, as well as a chart for the trade with a link to the trade so that you can track the trade yourself and you can modify it in Options Play if you want to see the trade in Options Play. And on the trade exits, what we do is the same thing. What we do is we have the trade itself. We'll tell you where to exit the trade, both either at a profit or at a loss. We will send you alerts. So here is a winning trade. Here is a losing trade that we had made to give you a sense for how these look. And these are sent, again, in real time to both your email and your phone for those of you that are interested in taking a look at these. And for those of you that have some questions, I will take a look at some of your questions here in one moment, but I do want to, before I start answering any questions, go through some live examples, just so, again, to show you guys these tools that are available to you here at Options Play. If you are not a subscriber to the credit spread trading system and you want to trade your own credit spreads, I want to show you how to utilize our system to do so. So first, I just wanted to take a look at the market real quick. You know, we've been in this very neutral 284, 293 range for a couple of weeks now, after that pretty kind of nasty sell-off we had for a couple of days. And it's really been sideways for a while. And we're trying to see where this will go. You know, is it going to break above 292 and resume its march back up to that 300 level? Or are we going to reverse back lower to that 284? We're in a very neutral range right now. So typically, this is a decent time to sell credit spreads, especially when the markets are not bearish. So what we were looking at are some sectors that were relatively strong in this particular market. That's consumer discretionary, consumer staples. Both have been pretty strong. So we have some names that we can take a look at here. Ralph Lauren, here's a stock that really has taken a bit of a huge hit And what we've noticed here on Ralph Lauren is that it reached what we considered an extremely oversold condition. And we're basically expecting the stock to move somewhat neutral, maybe a little higher, but mostly kind of sideways here after this extremely overbought range. So one of the things that we looked at was on Ralph Lauren was a credit spread here. So what we did is I flipped this to I'm bullish. I'm going to modify the stock leg to a credit spread. And what we're going to do is we're going to set up a credit spread where we're going to go out roughly 4 weeks here, so to about September 20th. And like we said, what we want to do is we want to sell an at-the-money put. So here it's about an $88 put. The stock is at $87.90. And what we're going to do is we're going to buy back maybe an $82.50 or maybe $83 put. And what, as you can see here, I have a $5 put, $5 with credit spread, and I'm collecting $155. So if you remember on our screen here before, we said that on a $5 wide spread, what we want to collect is roughly $1.67. So $5 wide spread, I want to try to collect about $1.67. So we're a little bit shy of that here, but let's see if, as you can see here, let's see, that's the worst possible execution price. On the midpoint, we're actually getting 185. So I'm pretty confident that if I tried to fill this order, I'm going to get close to about $1.67, maybe even a little higher, $1.75 or so. So this is really the type of strategy that you can look at compared to buying a call option or a call spread. Now, these call options and call spreads don't look particularly attractive because they actually don't list enough strikes to the upside. They only list strikes up to $94 when the stock is already at 88. So I don't think it's a fair comparison to buying the call spread. But if we look at the call itself at $490, I think the best way to really look at these is to first compare apples to apples. So let's say I'm willing to risk $1,000 on this trade. So I can sell 3 contracts of the call vertical on the call credit spreads, or I can buy 2 contracts of the calls. Now I'm comparing apples to apples. So Ralph Lauren's around $87.90 right now. There's a few different ways that I can look at this. Either this stock I think is oversold and I think it's going to bounce higher back to 100. Or I think the stock's just going to stay around where it is right now. So if I think the stock's just going to stay around where it is right now, as you can see, if I had bought the call option, I'd lose pretty much everything. Out of the 980, I would lose $900 if the stock stayed where it was. Versus if I'd sold the put credit spread, I make a $525 profit. So again, this is really where if the stock is neutral, the stock doesn't move at all, I can make money from it by selling a put credit spread, even if the stock moves slightly against me. So if the stock moves down to, let's say, 87, moves 90 cents down, I still make $255. So even if I call the direction completely wrong and the stock moves lower, I can still make money on this trade. That cannot be said for pretty much any other option strategy that you can trade. So this is really what makes, in my opinion, credit spreads attractive for this specific type of outlook. But on the flip side, if I do expect this stock to rally, even modestly to, let's say, $96, as you can see here, for the same $1,000 that I'm risking, $945 on the credit spread versus $980 on the calls, here I'm making $555 profit on the put credit spread. Here I'm making $720 on the calls. So again, if I expect a modest move to the upside, I'm going to make more money on the call option than I do by selling a put credit spread. So again, put credit spreads are useful when I expect a neutral move, but the second I get a bigger move in the underlying stock, I'm better off buying the call and even better off buying the call spread, which again, in this particular case, I wouldn't buy this call spread because there just aren't enough strikes listed on this. But as you can see, what I wanted to do is show you guys really how to utilize this tool to set up a credit spread or either a put or a call credit spread and quickly compare that to buying a call option or a call spread to see which one's best for you, because you can then go back to the drawing board. You can go back to your chart. You can go back to your fundamental analysis. You can go back to however you decided you wanted to go long Ralph Lauren and ask yourself, do I think the stock's going to rally up to $96 or higher? Because if you do, you're better off buying a call option. If you think the stock's just going to stay somewhere around the $90 area, you're better off selling the put credit spread. So this way you don't have to make a decision as to which strategy is best for you until you've actually set the two side by side. Another one I wanted to take a look at, here's a trade that we actually set out the other day, was PayPal. This is the technology company, relatively strong relative strength. Its stock, recently reached this severely oversold condition as the market sold off, but really had a pretty nice bounce and is actually breaking above some resistance levels. So these were some of the reasons why we started looking at this particular name. 108 was a resistance level that held a few weeks earlier, started to break out higher. So we did think that maybe there was a potential of this moving back up to that 112 area or so, which, if you bought a call option, not a specifically very attractive trade, but on the credit spread, far better. So let's take a look at this. If we sold a put credit spread, same thing, we were looking at the October, I think, 20th at the time. We would sell the 109s and buy back maybe the 104s. So roughly $5 $5 in width. And as you can see here, we're collecting 170. So exactly 1/3 of the width. These are the types of ratios that we want to look at. We want to risk roughly twice as much as the income that we're receiving. So again, if we go back to the drawing board and say we want to risk $1,000 on this trade, here I can sell 3 contracts with the credit spread. I can buy 2 call options, both risking just shy of $1,000. So let's compare these two side by side. So if this stock rallies back up to that 111, 112 area, which it was trading at just a few days ago, as you can see here, I make a $510 profit on the credit spread, but I lose $180 on the call. So even if I get the direction correct, but the magnitude is not large enough, I lose money on the call. Even on the call spread where I'm risking less money, I still lose money. So this is really where credit spreads shine, when you don't expect a large move, but you think the stock is going to stay within a certain level. You have a pretty fair amount of confidence that the stock's going to stay below 108. Stay above 108, selling that credit spread. Even if the stock goes down to 108, I can still make $210. So if the stock drops back to that support level, I'll still make money, versus here I'm losing $1,000. So then you can then ask yourself, do I think the stock's going to rally a little bit, or do I think the stock's going to rally a substantial amount? Because you can use this tool to figure out at what point does the call or the vertical start to outperform the credit spread. And that answer is around 115.21. As you can see, the vertical makes a $514 profit when the stock reaches 115. So if I do expect the stock to rally above 115, which is right around here or so, which is that second resistance level. So as you can see, the stock really needs to push past that second resistance level before the vertical or the call spread starts to outperform. So you can really utilize this tool not only to help you determine which strategy is best, but also based on different strategies, what type of outlook do you really need to even enter a call or a call spread? Because a call or a call spread is not always useful or not always suitable for every outlook. In this particular case, even if I'm bullish on PayPal, I wouldn't really expect that I'd get a push above 115. So as you can see, at 115, I do get the higher return on both on the credit spread versus the call and the call spread, even though I'm risking the same amount of money across the board. So this tool is really helpful in helping you set up any 3 strategies side by side, including a credit versus a debit spread. Like I said, I don't like to compare the two, but when you're really looking at a trade, many times you might want to utilize 2 strategies like this to ask yourself, how far do I think the stock can move? Because that's going to help you determine whether this strategy is suitable for you. So with that, I just wanted to remind everyone, credit spreads, it's a more advanced strategy. However, it is a strategy that is useful for many, many different scenarios, especially when you're near an overbought or oversold condition. But I will again reiterate, if you're selling credit spreads, make sure that you collect roughly 1/3 of the width of the spread, and the width referring to the distance between the two strikes. So when you're selling that 109, you're buying the 104, the distance between these two strikes are $5. You want to try to collect roughly $167 per contract. That's how you're going to be able to control your risk on this type of trade. If you're collecting less than 1/3 of the width, then you're going to be risking substantially more. You're going to potentially get yourself into some trouble, when you have a string of losses where you're going to lose a substantial amount of capital in your account. So keep that in mind when you're selling credit spreads. But with that, that concludes what I wanted to show you guys here today. I hope that this really was helpful in number one, showing you the details of this strategy and really understand the anatomy of a credit spread, because again, it's quite different from pretty much all other strategies. And hopefully, this shows you how to utilize our platform to better understand and analyze these strategies for yourself. And if you want to sign up for our service, you can sign up here directly through this link here, which I will again send into the chat window for everyone to sign up, so that you can take a look at a free trial of our credit spread signals, so that you can follow along, see how we generate these signals, see the expirations and strike prices that we utilize for this, and be able to look at the platform to set up your own trading signals as well. So with that, what I'll do is I'll open this up for Q&A. If you have any questions, please type them into the chat window, and I will spend as much time as possible to answer any questions you have regarding the tool. So let's see, looks like there's quite a few questions here already. Molly's asking, is there any time when you would sell a naked call? I would almost, I'll be honest, I don't think I've ever sold a naked call in my entire life, because there's no reason to. If you're selling a naked call, you might as well just buy a really far out of the money call option for just a few cents at the very least to cap your risk. There's really no harm in doing that. Your risk, you're capping your downside is trying to spend even 5 cents to buy a really far out of the money call to help offset your total risk is always better. Plus, your margin requirement to sell a naked call is substantially higher. If you simply just sold a call credit spread, even if that higher strike is substantially higher, you're going to reduce your margin requirement significantly. So just on that alone, I would never sell a call naked. I would always sell a call credit spread. Gary's saying, in the exit, the cut losses is confusing me. Which do we use? So Gary, it depends on whether the credit spread you receive is less than 1/5 of the vertical. So if you're looking at a vertical like the PayPal one we were looking at, right, where it's 109, 104, and we're collecting, let me move this back to one contract just so we're clear. So on a $5 spread, if I'm collecting less than $1, then that's when I want to use the other rule. So let's say I'm selling a credit spread that looks like this, right? So if I sold a 103.98 put credit spread, I have a much higher probability of profit, but my max reward is only 65 cents, which is less than 1/5 of the width. Because I have a $5 width, I'm collecting only 65 cents. So that's where I want to cut my losses if this credit spread goes up to about $1.30 or so. So 100% loss on 65 cents is about $1.30. So if this $5 wide spread goes from 65 cents to $1.30, it's time to consider cutting my losses. Versus if I had sold a credit spread that looks like that, where I'm collecting 150, then as soon as I lose 75 to 100% of the credit spread, that's when I want to start cutting losses. So it depends on the credit that you receive on the trades. And it really just depends on how far away from the current price you're selling your credit spreads that determine which strategy you use. So if you only use the strategies that we're showing you, then you only really have to worry about this one rule here. You don't have to worry about the second rule of selling credit spreads. Amelie, can you show the order link again? I just sent everyone the order link again in the chat window, so please go to the chat window for that. Ed is asking a great question. Do you also have a debit spread service? So Ed, everyone has access to our debit spread service. That's the one that we send every single morning at 6 a.m. You get a daily play signal from us, which we also send which we also send closing alerts for. So that is something that everyone already has access to. So if you don't have access to Options Play, you can sign up at www.optionsplay.com, which I just sent a link to everyone in the chat window as well. Desi, what do you think about selling credit spreads on SPX with 0 days to expiration? So Desi, if you can manage to collect enough premium to do it, by all means. I think that you're going to find that you're only able to do so on ones that are relatively close to the current price. So you're taking on a fair amount of risk to do so if the markets do have a big move on the close. But it is a strategy that many people do trade, and from my perspective, it's an absolutely valid strategy, just not something that most people do. James, from your suggestions, do you have a list of all the winners and losers and what your percentage of winners are? Yes, so we publish that as part of your subscription, so you can sign up for the free trial and you can see all of our trades. We publish every single trade that we've ever traded in this specific service. Greg, I love credit spreads. Will you look to defend if your short strike is challenged or take the loss? So we will take the loss if the short strike is challenged. Can you provide details or discounts to sign up on the debit spread service? So the debit spread service comes with your Options Play subscription, so there are no discounts, and it's provided as part of your Options Play subscription. Keith is asking, perhaps I missed this, but when will potential trades be texted out? Before market open or during the daily session? So all the credit spread signals are sent during the intraday session. So they are sent during the market session. Dennis is saying, please explain the circle number in the right side panel and how does it change? So the question, I think, was the Options Play score. So the Options Play score tells you the risk to reward ratio weighted by the probability of that risk to reward. So if you, in layman's terms, if you can think about a call option, as you can see, there's an amount of green, which is your potential reward, and there's an amount of red, which is your potential risk. And what we want to do is look at what is the potential for gains and what is the potential for losses, and weighting those two against each other, because a call option gives you unlimited reward, but that's not really useful because you don't really think that the stock's going to go to infinity by October 4th. So what we do is we look at what is a realistic trading range of PayPal between now and October 4th, and we actually show you what that expected trading range is. And we see what is the max reward you can get in this range, what is the max risk in that range, and we weight it by each other. So as you can see, the Options Play score here is not very great, because even if the stock rallies to 108, the gains here is not really much to offset the actually relatively high probability of you losing, $980. So even if the stock rallies up to 118, as you can see, you have 104% return, but the stock has to, if the stock is even at 113, you're actually just at break even. So anything below 113, you're actually losing money. So you really have a relatively low probability of making a 100% return and a relatively high probability of losing some money. And that's why the risk reward ratio on this particular changes. So what this does is it changes it based on the strike prices that you select, and it changes also based on the expiration dates that you select. It changes based on the expected payoff of each strategy based on the expected range of that stock. Ashok is asking, does it matter when you're doing a credit spread, you happen to be in the money? Not sure what you mean by that, because you can certainly select any strikes, but we tend to find that in the money credit spreads are not ideal, because you're really not actually taking advantage of the theta decay on a short credit spread. You want to be able to short an at the money or near the money call or put, and then buy back an out of the money call or put. We generally don't sell an in the money credit spread. Trevor, does the credit spread service give us full access and all the functioning of options play without an additional fee? No, that's a great question, Trevor. The credit spread service is a completely separate service. It doesn't give you access to options play. You still need access to options play to see if you want to analyze the trades, if you want to modify the trades, you still need an active options play account to do so. Now, you don't need an options account to sign up for the credit spread service. But if you want to analyze the trades using options play, if you want to modify it, you will need an active subscription to options play. Molly's saying, I noticed that the PayPal credit spread had a higher chance of success than usual. About a 55%. I don't know that that's necessarily higher than usual. I think if you're referring to if we sold these really far out of the money credit spreads, then yes, but those are not the credit spreads that I would ever recommend. Steve is saying, do you trade iron condors? And that's a really great question. The answer is no. However, we may find ourselves in an iron condor sometimes because an iron condor is really just a call credit spread plus a put credit spread combined with each other. So there is sometimes where we find ourselves where maybe when the markets are oversold, we sell the put credit spread, and then a few days later, the market rallies and we sell a call credit spread. So we might find ourselves trading a put credit spread and a call credit spread on the same expiration, and that forms an iron condor, but we would never enter an iron condor at the same time, because to enter an iron condor at the same time, you're effectively saying I'm both bullish and I'm bearish at the same time. And I don't have any technical indicators in my toolbox that tells me a stock is both bullish and bearish at the same time. So again, iron condors are useful, but they are more of a volatility-based strategy. So if you have a volatility forecast, maybe you might want to enter an iron condor. It's really a short volatility play more than anything else. But that's not the type of trading that we're doing here. This is more of a directional play. Is this recorded so I can watch it again? A lot to swallow. Absolutely. All of our webinars, just every single week, is recorded so that you can watch the recording with the slides and follow along at your own pace. I understand that this was a lot to digest, and that's why we purposely make all of our videos available for viewing afterwards. James, how do you notify users? Is it email or can you get a text also? So James, it's both email and phone notification. The phone notification is through the StockTwits app. So as long as you download the app and enable notifications, you will get real-time alerts on your phone. For us on the West Coast, why do you not send out recommendations the night before? For everyone, they are sent out during the market session. So because these are trades that you want to act on immediately. So that's why we send them during the market. We don't generate these trades before the market open. Molly, Trevor, Ashok, you're very welcome. Thank you so much for attending here today. John is asking, a question I keep asking myself when wanting to take an option position that is a call, put, or vertical spread are what strikes should I be choosing based on the trade I want to make, bullish, bearish, and sideways. Also, when should we be selling options in lieu of buying them? Statistics demonstrate that odds are better when we sell. So John, great question. That is really, I'm glad you asked these questions, but part of what we discussed here today and what we discussed here last week is really talking about all these things that you've asked, right? So the part of this webinar is to talk about when should you enter these trades, what strikes, what expirations. We went through all of that today for selling options. Last week we did buying options, when you should use it, what expirations, what strike prices, all of that. Today I talked a little bit about the statistics behind bullish versus bearish positions. As far as statistics around selling and buying, I don't have a strong indication that one is significantly better than the other, but that's why we don't just buy or sell options. We always trade the spread, which has both a buy leg and a sell leg, to offset exactly what you just said. So John, I'd love to answer your question, but I think the best way to really answer all of your questions is to really watch the video from last week and this week. So you can actually find that at our YouTube channel, which I will send a link to for everyone in the chat window. If you want to learn more about some of our videos that we've created, they are all available at the link that I just sent below in the chat window, where I did cover debit spreads, which is predominantly buying options last week, and credit spreads, which is predominantly selling. But like I said, we're never in the position where we're only selling or only buying. We're always doing both at the same time. So the options play subscription is separate from the credit spread service, or is this credit spread service included in the options play subscription? So the credit spread service is in addition to your options play subscription. You can subscribe to each one separately, but you're going to get the most value when you subscribe to both. Do you offer a discount for the options play subscription right now? So currently we do not have any discounts on the options play subscription. John is saying, great, we'll do. As always, great webinar with you as a host. Thank you so much, John. I really appreciate it. Any other questions? Steve is asking, are most of your trades debit and or credit spreads, unless long trades are better for your outlook? I would say almost all of my trades are either a debit or a credit, because again, I don't like to be either just long or just short an option, because just long, you have time decay working against you. Just short, you're exposed, from a risk perspective. So I'm always, I'm always a long and short at the same time. So either through a debit or credit spread. Calc risk, $7 risk. I don't know what that means, Kev, Kev. If you can clarify, I'm happy to answer that question. Ed is asking, I'm an options play subscriber, but I don't see the debit spreads daily email. Ed, if you can send me an email at info@optionsplay.com, I'm happy to look into that for you, but it is the daily play email we send out at 6 a.m. every morning into your inbox. And for those, and even if you don't get that email, you get the pop-up every time you log in that tells you when it's time to enter or exit a trade. So today we took profit on Netflix and Target, two pretty good debit spread trades that we entered recently, and so, but you do get that pop up every time you log in at the very least. Steve, thank you so much. I really appreciate it. Desi, same thing to you. Thank you for attending. Trevor, approximately how many credit spread signals do you anticipate per week or per month? It really depends. We go as high as 4 to 5 a week and as low as 1 to 2 a week. It really depends on the market conditions. The last few weeks have not been a particularly great time to sell credit spreads, so we've kind of lowered the number of trades. But when things, things picked up a little the last few days, so I think we've sent out 3 this week already. So it really just depends on the market, but I would say we average 2 to 3 a week. During slower times, 3 to 4 during more active times. Atul, thank you so much. Yes, I will see you next week on the TMX credit spread webinar for those of you that are in Canada. Andy, do you have a webinar for straddle and strangle? So we don't, because again, straddles and strangles, you're either all long or all short. And that means that you either have time decay really working against you, and that never works out in the long run, or you're all short, which means that you're exposed on both sides from a risk perspective, and that's not a strategy that we ever like. Plus, straddles and strangles from a true trading perspective is really a play on volatility. So that means that you really need a volatility forecast to do so. Now, I don't know of any retail traders that have strong volatility models that tell them when volatility is going to expand or contract without a lot of directional movement. So I don't recommend retail traders, in my opinion, to trade straddles and strangles, because long straddles and strangles don't work out very well in the long run. Short straddles and strangles require very, very accurate volatility forecasts and require extreme money management skills to do so. Not to mention that many people don't even have the ability to go naked short a straddle and strangle. KKev, $7 risk against $3 reward. How is that calculated? Okay, I think I understand your question here. So the question here is, how did I calculate that the max reward is $3 and the max risk is $7? So the max reward of $3 is very simple. It's simply the the credit that I receive on the trade. So I sold the 100 strike put for $4. I had to buy the $90 put for $1. So the difference between that is $3. So that's my max reward. On a credit spread, the most I can make is the income that I receive. The max risk is the difference between the two strikes. So the difference between the 100 strike put and the $90 put is $10 minus the $3 that I receive on the income. So the difference between the $10 and the $3 is my max risk, the $7. So that's how you calculate risk and reward. On any vertical spread, the distance between the two strikes is the opportunity. Whatever your max reward is, the rest of it is going to be your max risk. So it doesn't matter whether you're trading a debit or a credit, that math works exactly the same way. Which strategy should we employ when the actual option cost differs significantly from your published estimate? Mitch, I'm not sure what you mean, because you can always go into options play, look at the trade, and we'll show you the current price. So if something is substantially different from what we publish, that simply means that perhaps you're a little late on that trade, and maybe it's just not the best to continue trading something. But if you still believe it's a valid trade, you can always log into options play, plug in the bullish or bearish strategy, and use maybe newer expiration dates or newer strike prices and see the most up-to-date pricing. That's how I would suggest you utilize our services. And that's really the point of not only providing you guys with the education, but also the tools, so that, it's one thing to take our credit spreads and follow them, or even our debit spreads and follow them. But if, let's say, I put out a trade on PayPal 2 days ago, and maybe you missed it and you want to trade PayPal now, then you log into options play, you click on I'm bullish or I'm bearish, and you simply set up your own strategies, and with new expirations, new strike prices, and the most up-to-date pricing. What we really want to do is make sure that you're not just following someone else blindly. We want to educate you. We want you to be able to be self-sufficient in your trading, and that is really the value that we try to provide here at Options Play. Do we trade credit spreads on SPX? I personally don't. I know a lot of people do, and it's not. I have nothing against SPX. It's just not personally something that I trade. Is that means debit and credit spreads is volatility neutral? I wouldn't say debit and credit spreads are volatility neutral. They generally do have smaller volatility exposures compared to long calls or short calls. Or naked, options, but they certainly are not volatility neutral. Debit spreads are long volatility, and credit spreads are short volatility. Any more questions? These are great questions here today. An increase in volatility make option price for debit and credit spread increase, or does it not affect the price? It does. So an increase in volatility is good for debit spreads and bad for credit spreads, and vice versa. A decrease in volatility is good for credit spreads and bad for debit spreads. Richard, having trouble signing up. What is the issue you're having there, Richard? And again, if you have any issues with anything, you can always send me an email at info@optionsplay.com, and I'll answer any questions you might have there. Any more questions? If there are no more questions, again, I just want to thank everyone for taking the time out here this afternoon. I have a really good session for everyone next Thursday. It's I believe, a topic that I have not done here for the US side. It's enhancing your equity positions using options. It's a webinar specifically for those of you that are investors with equities. Whether you buy equities for the long term, you have them in your retirement account, any type of equity investments, we're going to talk about how to enhance those using options, and really talking about how to systematically enhance your equity positions using options. So I'm really excited to show you guys that next week. I hope to see you there. I hope everyone has had a great week, and happy Thursday, and I'll see you guys next week. Have a great week.